We begin our topic on trading on feelings, sentiment indicators, with a small puzzle for you. The puzzle is this: you are standing at a crossroads where you have the power to pull a lever to channelize an oncoming train either to the left side or to the right side. You know that to the left side there is only one man working on the tracks, and to the right side there are five men working on the tracks. Which side will you send the train to? Now, logically, the correct answer would be obviously towards the left side because you are saving the lives of five men instead of one man. However, assume that 5 seconds before you pull the lever, an information reaches you that the one man who is working on the left side is your father. Will it make a change to your decision? Well, the answer is in your minds. This brings to the foreground a very important parameter, which is what is the impact of emotion on logical decisions. When we enter the stock market trade, all of us are talking about logic and fundamental analysis and technical analysis and so on. But what about sentiment? Sentiment is a very important parameter in the decision-making process of human beings in all aspects of their lives. The market is just one aspect of their life. The philosopher René Descartes, who gave us the XY coordinate system, did not believe that emotion has any impact on human decisions based on logic. Well, turns out he was not right. And there is a book which is given in our comment section called Descartes' Error, which explains how human decision depends deeply on emotion as well as reason. Go back to the last 3 years of your life and recount the decisions which you have taken based purely on emotion, purely on reason, and a combination of the two. Let us now try to understand how cognitive science defines the emotions which go through us as human beings throughout our lives and definitely throughout our lives in the markets. Now, first of all, markets consist of people who have emotions. Therefore, markets follow the principles of behavioral finance. The rational expectation hypothesis, which says that markets as well as humans will always act rationally, is thrown to the winds when we come to market bubbles like the tulip mania, which came in Holland in the 1600s, and the several crashes which we have seen over so many years. Now, let's take a look at a few other factors related to sentiment before we move on to sentiment indicators. Now, market sentiment is the collective mood of the market crowd. And what controls the market crowd? Price is the leader of the market crowd. That is why technical analysis, which essentially treats price as the main component of its analysis, is one of the best ways for short to medium term analysis in the markets. GameStop is an example of how the market crowd can come together and create havoc in the market. In 2021, a bunch of retail traders on Reddit took out the heavyweights and beat them. There were hedge funds which had to shut down because of groups of retail traders who took it upon themselves to work against logic and purely on sentiment to take GameStop to heights which were unimaginable under any kind of logic. Now, markets make charts and not vice versa. Please do not think that whatever you have seen on a chart is going to happen in the market. Very, very wrong concept. Markets rule supreme. Black swan events, acts of God can trigger sentiments which will overtake all rational logic and thinking. Therefore, the rational expectation hypothesis is not valid in the market under all conditions. Sentiment indicators have a high percentage of success, which we shall be learning shortly, when used as contrarian indicators. Sell when the crowd has reached limits of euphoria and buy when there is blood on the streets. This is the basis of sentiment indicators. The three main sentiment indicators which I intend to introduce you to today are the Fear and Greed Index introduced by CNN, which uses 7 weighted indicators, the VIX and the PCR. These are all mathematically precise, noiseless indicators which will give you a clear indication of something as abstract as sentiment and emotion. Now, here are the indications which go into the fear and greed indicator: the stock price momentum, the stock price strength, the stock price breadth, put and call options, the junk bond demand, market volatility, and the safe haven demand. Now, without going into the details of these, which may be complex for a newcomer or people who trade the markets, let us understand the outcome of this entire indicator. The outcome is very simple. The range of this indicator is from 0 to 100. 0 to 25 may indicate extreme fear, the contrarian signal of which is buy. 75 to 100 may signal extreme greed, the contrarian of which is sell. As simple as that. Now, this indicator is available on various websites on the internet, so you can have a look at this indicator and take your decision accordingly. The put call ratio measures the ratio of the volumes of the puts to the volume of the calls. There is a second definition that it measures the ratio of the open interest of the puts to the open interest of the calls. I would prefer the second definition over the first definition because it gives a more accurate value of the put call ratio. This indicator essentially measures the swings in sentiment between the bulls and the bears. The lower the ratio, the more bullish is the crowd and the more likely that the market is going to decline and vice versa. Now, the daily usage of the put call ratio is very simple. If today's PCR is less than yesterday's closing PCR, then the market outlook is likely to be bearish. We should look for short trade setups based on bearish reversal patterns like hanging man or dark cloud cover or trend line breakdown or Bollinger Band breakdown and so on. If the PCR of today is greater than yesterday's closing PCR, then the outlook is bullish and we should look for long trade setups based on bullish reversal patterns like the hammer, the bullish engulfing pattern, or a breakout outside a channel or a breakout from a Bollinger Band and so on. In terms of intraday usage, if the PCR is increasing during a correction in an uptrending market, then it is a bullish indication. It means that put writers are aggressively writing at dips. And if the PCR is declining during a correction in a downtrending market, it is a bearish indication because it means that the call writers are aggressively writing on the rallies. Finally, we come to the last indicator, which is the VIX. The VIX stands for the Volatility Index and it is calculated from the out-of-the-money options of an index, in our case, the Nifty. In the US, it will be the NASDAQ or the S&P 500. A low level of the VIX is a warning of complacency, while high levels signify fear. Normally, VIX moves in a trading range. Now, this trading range is not static. This trading range can be dynamic to the extent that the entire range may move up or down depending on fundamental changes in the structure of the market. So, it is important to look at the chart of VIX and understand what the trading range is by appropriately drawing horizontal lines. Another way to analyze the VIX is to use the VIX to VXV ratio. What is the VXV? The VXV is the 3-month forward VIX index. In other words, instead of using the current month options, we use the 3-month forward options and we calculate the ratio of VIX to VXV. A very low value is a sign of excessive complacency because now you are comparing the short term to the medium to slightly long term and is a probable sign that the market is dangerously complacent and could fall if accompanied by a bearish price reversal pattern. Similarly, high values indicate excessive fear and indicate that the market will probably bounce back if accompanied by a bullish price reversal pattern. Now, the combination of PCR and VIX can be used to generate buy and sell signals in the market. So essentially purely based on sentiment indicators with a combination of price. Remember, indicators are only indicators. The final outcome of any trade ultimately comes from the price. The buy and sell signals can be as follows. If the PCR is increasing on dips during an uptrend and is greater than 1.2 and the VIX is in the top 20% of its trading range, then it is a buy signal at a Fibonacci retracement of the last rise during the dip where a bullish pattern appears. In other words, when the market corrects during a dip and we reach a Fibonacci retracement level where there is a bullish pattern, it is time to buy based on the confluence with the sentiment indicators. Similarly, if the PCR is declining on rallies and is less than 0.8 with the VIX at the bottom 20% of its trading range, then it is a sell on Fibonacci retracement during rallies, provided that a bearish reversal pattern appears at that Fibonacci level. This is how you can combine sentiment indicators with price patterns to generate highly reliable signals in the market. So here are two examples of such trades based on hourly charts. One, a buy signal and secondly, a sell signal. Please remember, as I've told you again and again and again, that all indicators are exactly what they are called, indicators. The real movement in the market is based on the market leader price. Only when price confirms or confluences or supports a VIX or a PCR or a fear greed index will you take action. This is what sentiment is all about. Please remember that sentiment is very, very important in the market. And I would suggest to you to spend time in going through this video maybe twice, thrice to fully understand the implication of what I've told you so that you have a fruitful career in the stock market, because sentiment is going to be a very big part of your career. Please like, share and subscribe to our channel. We are attempting to bring you high quality videos so that your knowledge about the market is greatly enhanced. You look inwards and try to understand the external world in a better manner